Hey everybody, in today's video I'm going to talk about dividend yields and how they can change when a stock price changes. And so for this example, I'm going to use FedEx as an example because the stock recently crashed after they released their earnings report. So I'm going to show you how that impacts the dividend. So I'm going to start with pulling in the annual dividend that the company pays. So one way to do that is go to the FedEx site, and we can see that it pays $1.15 per quarter per share. So if we want to know the annual dividend, what we just need to do is take that 1.15 multiplied by 4 quarters. So we know that FedEx pays $4.60 every year per share. Now obviously that can change from one year to the next, but that's the current rate that it's at. So the next thing I'm going to do is pull in the stock history and use the stock history function. So FDX is the ticker symbol for FedEx, and I'm going to put the start date as the start of the year because, that's when it's been starting to pay the dividend from. I need to put in let's say today's date as my ending, and there we go. Now I've got the date and the closing price, and if I want to calculate the yield, all I need to do is take that dividend divided by the closing price. I'm going to freeze that annual dividend and copy it down. So the idea with the dividend yield being that, you're getting a percentage of the money you invested back. And the reason the yield changes is because these prices change. So, at the start of the year is $258 a share. And if you're getting $460 on that per year, your yield is 1.78. But as the price is lower, let's say here at $244, the yield's 1.88% because now you're earning more of your original investment on your original investment because technically, FedEx is paying the same dividend regardless of whether you buy it here or here. The only difference is it's actually costing you less to buy it at a lower price. Hence the incentive to buy a dividend stock when it goes down because now you're earning a higher percentage. Assuming that yield stays the same and nothing's changed, you're still collecting that same dividend regardless of whether you bought it at the higher price or the lower price. But at the lower price, it's a higher percentage of your investment. And so I'm going to illustrate this using a chart. So if I go to Insert, Line Chart, and you can see now I've got that yield and the closing price, but I'm going to select just the yield for now. And now if I format this axis, just to make it stand out a little bit more, let's say 1.5%. Now we can see the change in price not the change in price, but the change in the yield. So, it's been as low as, about 1 point, dipped to below 1.74 here, and, been as high as, about 2.33% in May. So obviously that time the stock price was going down. So another way to show this is I'm going to actually include the closing price as well. Except now what I'm going to do is actually change this chart type because I want a combination. I want them both to be lines, but one's going to be on a different axis. And now by doing so, you can see that they're perfectly mirror images of one another. Now one thing I'm going to do is adjust these ranges one more time just to, again, make this a bit more obvious. So let's say 197, what I think was about the low for this one. And for this one, I'm going to use 1.7364. There we go. And so I just looked at the minimum values for those fields. So as you can see now, it's a little bit easier to see that, as the closing price is going down, the yield is going in the opposite direction. And so this is really the incentive with buying dividend stocks when they're going down, because as long as you have the confidence that the company is going to continue paying a dividend, then it makes sense to buy it at a low price, because that means your yield is higher and you're getting more for your money. So that's the relationship between the dividend yield and the closing price. It's essentially an inverse relationship where, if a stock's doing well, it's going high. going high up in value, then that yield is coming down. But when the stock is crashing, the yield is going up. So, as long as you're confident in the company's financials and its future, then it definitely makes a lot of sense to buy it when the stock goes down.